Stop whatever you're doing right now and listen carefully. Put your phone down, focus fully, because missing this warning could cost you everything in the markets. If you skip this message, you risk missing the most critical market alert of the year, one that could reshape your financial decisions and future security. Before exposing the $12 silver data, I need to know who is tracking this global crisis with me across continents, time zones, and economic realities. Drop a comment now telling me your country and local time, because this crisis spans the United States, Australia, the UK, Canada, and every region worldwide. This situation affects every time zone on Earth, every economy, and every household, indirectly tied to global commodities, currency stability, and the fragile structure of financial systems. Share your location below immediately. Then we'll move into the hard data, the numbers, and the forensic evidence that confirms this unprecedented silver market dislocation. You saw the title, you saw the warning, and I am telling you with absolute certainty that this situation is real, measurable, and unfolding right now. While Western financial media remain silent, focusing on tariffs and court rulings, physical silver in Shanghai effectively reached $12 per ounce equivalent pricing. Meanwhile, New York COMEX prices trail between $87 and $91, creating a massive arbitrage gap pulling physical metal from Western vaults at unprecedented speed. We are exactly 24 hours away from the most consequential COMEX deadline in modern commodity history, and the forensic data confirms every claim presented in this report. Before breaking down the math, we need a conversation. We are building a mastermind community of critical thinkers here, and today I will engage deeply in comments. I will read your arguments, reply to strategies, and encourage debate, because clearer decisions emerge when reasoning is challenged and defended against intelligent opposing viewpoints. So let us debate. With only 24 hours before first notice day, will COMEX survive this physical drain, or is a systemic default approaching rapidly? Comment survive or default below and explain your thesis, your calculations, and your reasoning, because collective intelligence sharpens insight in moments of financial uncertainty. Pause the video now, post your argument, support the truth by liking, ensure you're subscribed, and prepare as we open the case file together. If you watched yesterday's report, you know we exposed the 150-day tariff trap and the legal time bomb buried inside Section 122 of the Trade Act. We showed how JP Morgan's $6,300 gold target reflects institutional abandonment of paper assets and strategic positioning ahead of a physical shortage. What you are seeing in silver today is the same exodus, happening faster, more acutely, and with a hard deadline of tomorrow morning. The gold story spans 12 months, but the silver story is a 24-hour emergency requiring immediate attention and disciplined analysis. Let us begin with the Shanghai premium, the single number revealing where physical supply truly resides in today's fractured global silver marketplace. Raw data from the Shanghai Gold Exchange shows the silver benchmark fixed at 20,182 yuan per kilogram on February 24, 2026, after Lunar New Year reopening. At approximately 7.25 yuan per dollar, that base price converts to about $90 per troy ounce, representing only the exchange floor. The media ignores that actual wholesale silver in Shanghai carries an additional 10 to 16% premium due to severe physical scarcity on the ground. Accounting for that premium, delivered physical silver in Shanghai effectively trades between $99 and $104 per ounce in real-world transactions. Multiple sources confirm approximately $12 per ounce equivalent difference compared to Western pricing, highlighting the severity of this physical market dislocation. Compare that to COMEX closing near $84.50 on February 24th, recovering to around $87 with intraday highs near $91. This creates a base arbitrage gap of roughly $17 per ounce, a 20% premium for physical silver in Shanghai versus paper contracts in New York. However, that $17 gap understates the true dislocation when factoring Chinese VAT, export costs, and air freight expenses for physical metal transport. The full arbitrage incentive reaches $34 to $36 per ounce, representing a 43% incentive for Western traders to ship silver to Shanghai. Under normal market conditions, such a premium would trigger immediate institutional arbitrage, rapidly closing the gap and restoring equilibrium across global commodity exchanges. Traders would flood metal from London and New York vaults into Shanghai until premiums collapsed, because that is how efficient commodity markets are supposed to function. The reason this divergence persists is structural, rooted in 3 barriers China implemented that prevent silver from leaving domestic markets despite massive profit incentives. First, silver was added to China's export control list effective January 1st, 2026, restricting outbound flows and tightening domestic supply for industrial consumption. Second, only state-certified firms producing at least 80 tons annually and holding credit lines exceeding $30 million may legally export silver under MOFCOM licensing. Third, domestic demand from electric vehicles, solar manufacturing, and electronics has effectively locked China's silver supply within national borders for strategic industrial priorities. Analysts state clearly that these restrictions trap silver inside China to feed domestic consumption, preventing arbitrage despite enormous profit incentives. This is not a temporary imbalance. It is a structural fracture in global silver pricing that worsens hourly as physical supply remains geographically trapped. Now we turn to COMEX vault data, where the story becomes mathematically terrifying and exposes the fragility of Western paper silver markets. Total COMEX silver stood near 366 million ounces in February 2026, already down 31% from 532 million ounces in October 2025. But total inventory is misleading. The critical number is registered silver, the only metal certified and available for direct futures delivery obligations. Registered COMEX silver has collapsed to roughly 88 million ounces, representing a 75% drawdown from approximately 346 million ounces in 2020. 75% of deliverable silver removed in 5 years, and the drain is accelerating rather than stabilizing, signaling structural stress in exchange inventories. January 2026 alone saw 49.4 million ounces removed from COMEX vaults, more than 4 times January 2025 withdrawals, consuming 26% of total inventory. In the first 5 days of February, an additional 19 million ounces were requested for delivery, confirming sustained physical demand despite extreme price volatility. The average daily drain rate now approaches 785,000 ounces per day, a pace that rapidly erodes remaining registered inventory. Shanghai futures exchange vaults held roughly 318 tons, about 10.2 million ounces. Before Lunar New Year, down 89% from the 2021 peak. Combined deliverable silver across COMEX and SHFE totals roughly 98 million ounces against 800 to 868 million ounces of annual global demand. The 2 largest futures exchanges hold barely 10 weeks of global consumption, exposing a profound imbalance between paper claims and physical availability. Now examine the paper-to-physical ratio, revealing how exposed institutional shorts are as first notice day approaches. CME data shows total open interest of 131,496 contracts, representing 657.5 million ounces of claimed silver against only 88 million deliverable ounces. Focus on the March 2026 contract facing first notice day. 22 of those 166 contracts represent 114.8 million ounces against 88 million available ounces. That creates a shortfall exceeding 26 million ounces, metal that simply does not exist in deliverable form within exchange vaults. Historically, only 3 to 5% of contracts stood for delivery, with most rolling forward into future months. In February 2026, delivery demand surged to an extraordinary 98%, showing buyers demand physical metal rather than paper settlement. Even during the January crash from $121 to $64, millions of ounces were still withdrawn, proving large players seek physical supply, not paper profits. Addressing rumors directly, account suspensions in Shanghai are real, documented, and targeted coordinated short selling designed to suppress domestic silver prices. SHFE issued notices confirming multiple account groups exceeded position limits and imposed trading restrictions targeting coordinated manipulation attempts. By mid-February, 22 account groups were suspended within 1 week, demonstrating aggressive regulatory enforcement against downward price manipulation. China increased price limits and margins, protecting physical supply and punishing manipulative shorts, a stark contrast to Western regulatory responses. Meanwhile, CME margin hikes forced leveraged longs into liquidation, enabling institutions to cover shorts at distressed prices during the January crash. JP Morgan reportedly closed short positions near mid-70s pricing, while simultaneously standing for delivery of millions of ounces of physical silver. 2 exchanges, 2 philosophies. China protects physical supply. The West deploys margin mechanisms that pressure retail longs and stabilize institutional short exposure. With registered COMEX inventory at multi-decade lows and delivery claims exceeding supply, do you trust paper prices or physical Shanghai pricing? Comment paper or physical below, and engage with this community tracking real money flows rather than managed narratives from mainstream financial media. Now the final verdict. Tomorrow, February 27th, 2026, is first notice day for the COMEX March silver futures contract. Any long holder not closing or rolling signals intent to take delivery, forcing shorts to deliver metal, buyback contracts, or accept cash settlement. At $90 per ounce, each contract represents a $450,000 obligation, leaving shorts with only painful options under extreme physical scarcity. Option 1, deliver metal from vaults lacking sufficient inventory to cover all claims, exposing systemic inventory inadequacy. Option 2, buy back contracts amid overwhelming physical demand, driving prices higher and triggering a short squeeze feedback loop. Option 3, accept cash settlement, confirming publicly that paper-silver contracts cannot fulfill the fundamental promise of physical deliverability. The Silver Institute projects 2026 as the 6th consecutive global silver deficit year, with cumulative deficits exceeding 820 million ounces since 2021. 88 million ounces of registered inventory represents barely 10% of annual production, highlighting the fragility of exchange-based pricing mechanisms. Samsung recently secured a 2-year offtake agreement for a Mexican mine's entire output, bypassing exchanges and signaling distrust in centralized supply channels. When corporations bypass exchanges to secure supply directly, the paper pricing mechanism is being abandoned from the demand side. This is not a trading story. It is a structural revolution in how physical silver is sourced, allocated, and valued globally. We are 24 hours from first notice day, institutional shorts are trapped, vaults are depleted, and Shanghai pays dramatically higher physical prices. What is your move before the deadline? Are you holding physical metal, monitoring inventory data, or waiting for volatility to settle before acting? Comment your strategy, reasoning, and time horizon below, engage with others, and understand what smart money is being forced to do right now. Subscribe and enable notifications. We are tracking this countdown in real time, covering every development leading into the first notice day deadline. I will see you in the comments, where the real analysis happens and where collective intelligence helps navigate one of the most critical market moments in history.